Web3 is better for business. Not just that it's exciting, not that it's just cool, and you have tokens and you have NFTs, but why is it better for business? Why is this a better business model? Okay, a couple reasons. These are the 6 here that I've included. 1, fundraising is easier, right? Ownership is much easier and makes sense. Marketing, easier. Governance, easier. Liquidity, better, faster, and more market-driven. Expansion into new markets, easier, right? And we'll talk about each one of these, but I do highly recommend taking the time to watch this video from the CEO of Coinbase, Brian Armstrong, talking about setting up and scaling a crypto company. And he talks about a few of these and why it's better, right? So let's talk about fundraising. The current and legacy model is venture capital, right? You got to go beg hundreds of rich dudes to fund your startup, and it can take months to a year, and it's rare to get anything. And if you're not in a market like Silicon Valley or New York or very robust financial hotspots, and you're well connected, the chances that you're going to get anything for most people on the planet are 1 in a million, right? You're probably not going to get funded. It's a bunch of elite rich people that decide if they're going to give you $1 million, $2 million, 10, 20, whatever to you, right? And it's not a good model. But now we have democratized fundraising, whether it's an ICO or an initial exchange offering or an initial DEX offering or selling NFTs to get funding and then exchanging those NFT ownerships or airdropping tokens to those who own the NFT. There's all these new models to raise funding. Now, not all of them are easy to do because there is some regulations around some of them, particularly ICOs. But the point is, it's much easier to raise capital. So you have democratized fundraising, which allows for the risk to be spread across thousands of small investors and users. So if you're a user, you might invest $100 in something because you think it's going to ultimately create $1,000 of value, right? It's not a big risk, right? But 100 or 10,000 people paying you $100 is $1 million versus going and asking one rich person for $1 million to take a bet on you. The chances that they want to take their $1 million and give it to you is far and few between because they don't want to we're not talking about there's only less than 3 billion billionaires on the planet. Billionaires can throw away $1 million like it's nothing, right? But that's not the majority of investors. The majority of investors, are not just throwing $1 million out there. They have to really do their due diligence. They have to figure out the right company. But it's very easy for someone to say, "I'll throw $100 at this," right? That might be, just not that much money for someone to make an investment, right? And that's $1 million of funding, though, for that company, right? And the risk is spread across all of these users. And you have the power of numbers, okay? Ownership. Today and historically, we've had stock, right? Here's an example of a Netflix stock option. It's really not liquid until someday in the future, and maybe never. Almost never does a company even make it to a true public liquidity position where you can trade your ownership on a market where the market's determining the price, right? Most companies either fail or they end up selling to a private equity company or something of the sort, and only those insiders even make anything. So it's very, very rare. Right? But even if it is going to happen, it's not liquid until someday in the future, right? And it has none or almost no utility. Its only utility is voting rights, but you can't actually use the stock certificate to do anything versus a token, which you can actually create some utility for the token. You can use it for a number of things. You can use it as accessing new features. You can basically allow people to tip with that currency. I mean, whatever your app does, you can create utility for it. If it's a DeFi protocol, you can stake it. You can use it as a trading pair. There's a lot of different options for it. But a stock certificate does nothing except for say, here's a piece of ownership you have in this company, right? And there's no demand for that other than the promise of future revenue growth, which makes me speculate on the fact that owning this is going to be worth something. Now, some public stocks do give you dividends, so you can earn some recurring passive income from owning that stock, and that's probably the only real strong utility that I can think of for only a very elite few stock options. But today, you have tokens, right? Tokens are liquid after lockup, and you don't even have to have a lockup, but a lockup is a good idea to create trust from your user base and to create a little bit more of a long-term thinking, because there is some incentive into getting people to commit to more time than, say, 6 months, and they just dump it, and then everyone loses their money because the founders all cashed out during some hype cycle. But it's liquid after lockups. You don't have to wait for 10 years, 20 years. You can sell some of that to the market as the product you're building has value. It's transferable. You can easily change ownership. I can send it to someone. Now they own it. There's no intermediary legal company that says, oh, here's a stock certificate. It's a different name. Now I got to change the name of it. You got to pay some fees. No, if you own the tokens and I transfer to someone else, they own the tokens, right? And you can self-custody it. You don't have to rely on a third party to manage this, like Carta or some lawyer. You can own these yourself. And it does typically come with utility, like I mentioned earlier, and what you can do with tokens. It makes sense to own and hold Ethereum or Cardano or whatever, because if you're going to do a transaction, you got to pay in the fees in that currency, right? Amongst other things that give it value, okay? All right, let's talk about marketing. So marketing is much better in Web3 because historically, you're going to raise a bunch of money from investors, and then you're going to spend tons of money on Facebook and Google ads because you need eyeballs. You need people to care. But you're competing with all of these other people that also want eyeballs, right? It requires a significant investment with costs going up all the time because more and more people are competing for those eyeballs. And then it creates competition for attention and ad blindness. People start just to ignore it because they're like, I don't need to see these ads. I'm bombarded with ads, right? And I know a thing or two about that because Instapage and PostClick are focused on those industries. But now tokens incentivize word of mouth, right? So it solves the cold start problem because people are incentivized monetarily to tell other people about it, to invite people in. It's essentially free marketing due to incentivized networks spreading the word to their friends and family organically to say, hey, check this out. Why are you going to use this service when you can actually own part of that service? You can actually own part of the stock exchange, not just use the stock exchange, right? So come check it out. Or like the examples I showed in the beginning, like with Audius and music. Why just use Spotify and pay these fees where you can actually be contributor to that and earn all of these tokens for contributing music, or by the amount of engagement you have, you're earning tokens as well for engagement and contribution to the community. Why would you not tell someone about that, right? So it essentially solves the issue where you previously just had to buy people's attention. Now people are self-motivated and they're talking about it on places like Reddit and Twitter and Facebook and YouTube, and they're telling people about it, right? And you're not paying them dollars in that. They're hoping to increase the value of that network, right? People want Audius to beat Spotify ultimately, because how much better would it be if musicians could own more of their income from the music they can create, and the listeners can be contributing directly to those artists that they care about. Okay, governance. Let's talk about governance. So then you used to have this small elite board, right? A board is typically made up of, in large part, by the investors who are not the users, right? And they're missing substantial context on the business because they're not in there day to day. They're not users. They're not creators. They're just there as financial people. So decisions can be slow, and incentives are often misaligned because they're in there for some short cash grab and they don't really understand everything that's going on because they're just the money. But now governance tokens, tokens can have decentralized organization voting rights. So any holder of the token that provides governance rights can vote on chain to release funds from a treasury, right? And if you're a user and you're an owner in this token, you're going to take the time to say, yeah, we should pass this. No, we should not pass this, right? And it empowers the users and aligns the incentives in a seamless, code-driven way rather than this legacy board, inefficient way with a few powerful people. Okay? Liquidity, right? Liquidity is dramatically improved because now, again, like we were talking about earlier, in order to get mass liquidity and exchange your ownership on a market, you got an IPO, initial public offering, right? You got to work for 10 years, give away 90% ownership to investors, and still probably never reach liquidity. But if you do, bam, and let's hope that you're a billion-dollar company because you got to get that valuation to have any meaningful return for the employees or even the founders in many cases. But now we have decentralized exchanges, right? You can add liquidity to a DEX and let the market trade freely. Release team tokens over time using time lock wallets like we talked about, so the team can release these tokens and then trade them on the market and receive some value from their work for the first couple of years, not wait a decade. Okay, my dog's trying to get in 1 second. Okay, just fed my dog, and this is the second time I've had to pause. So I know this is long, but this is a really big potential shift in where we focus our time on, and it's a big investment that I want to make, and I do think it's an opportunity to have a lot of fun while making a lot of money, right, in a really cool industry. So again, this is why the liquidity is much better and much more open to many more businesses much earlier in the process of value creation, right? You don't have to be a multi-billion-dollar company that raised $200 million and then was able to go public, right? In a big part, too, because the tokens have utility, right? Now, it's still early days, and there's still a lot of things out there that are scammy or not valuable, but it's up to the industry to continue to create real valuable things, and tokens will drive value creation in a seamless, borderless way, okay? Which brings me to the last piece of this, which is about global expansion, right? Now, today, how things work is it's very difficult for payments integration because we have all these legacy banking systems, legacy systems of moving money around because they're not on a blockchain modern technology. It's very, very hard. And you have to basically have this very costly, difficult payment integration one country at a time. But now you have tokens. This is an example of the ApeCoin, which I used a couple other times in the presentation. But now you have tokens. Crypto enables a global user base from day one. You can move tokens from one wallet to another. And of course, as countries add regulation, you will have to have some know your customer laws. But even there, they have innovations like DIDs, which is decentralized identity, where you can opt in to give it to authorities, and you can access dApps unless you have that. So you can give that information away as needed in a decentralized way and not rely on a centralized company to verify identity and whatnot. So there will be some friction to all of this working out and countries deciding how they're going to allow it and whatnot. But it's not going to be eradicated unless it's an authoritarian, autocratic society like China. So that means most of the world's going to be embracing these new things. And so just to recap, right? Again, the business model is better for global expansion. It's better for liquidity. It's better for governance. It's better for marketing. It's better for ownership. It's better for fundraising. How can you compete with this new model, right? So where does that lead?